What's going on, everybody? I got your watch list for the first trading day of May, so get ready. But before that, I'm going to go over my play that I made here on Apple. I'm going to show you guys the transactions and break it down because it was pretty confusing, and you guys are going to see how I got to bet, well, 130,000. So I actually put down $10,000 of market value of options. Those are going to be, there's 9 trades we're going to go over. So I'm going to start with those and then go to the watch list so I don't cheat you on the clickbait. Why I say 130,000? Because you're going to see a mix of all sorts of plays here. I did both selling options, buying options, spread. So you're going to get an idea here. But the initial play that started this, I sold 5 options or 5 calls at 215 on Apple. So 215 times, 5, every contract is 100 shares. I sold 5 of them. That's 500 shares. I agreed that I would buy them or I would sell them to somebody. So the carrying value on that's 107. Then if you saw today on stream, now that's the best part. You guys saw all of these happen on stream. You guys even saw my epiphany moment, but added to another call. I sold another 230. It brings it to around 130,000. So I bought some options, but that's the carrying value. The max risk on this is theoretically unlimited, and that is the crazy part about this trade. This is a different trade than some of the options you guys have seen before because you can lose more money than you put in. So be careful with this. Again, all these plays, I even said, this is educational purposes. Some of you could find it entertaining as well too. But at the end of the day, use this as an opportunity. I'm showing you guys, I don't know how these are going to open. You guys are seeing my logic, my theory. I'm trying to outline it for you, the logic. Hopefully you guys could take something away from this and learn from it. But the best way to describe this, the stream, everything, it is not watch me trade to copy my trades and do that, but you could watch my trades and learn off of my money. You guys don't have to lose money to make the same mistakes making money. You could see how these trades worked out. So I'm sure a lot of you guys wanted to do some weekly contracts. I got some of those. We did some premium selling. I did some buys. So I broke it up. And again, I explained this on stream. It was very confusing. So let's get into it. Damn, I'm such a tease. I forgot. You got to like the video. Drop the thumbs up on the video and make sure you are on stream because we are going to be trading these and you can see the results and everything happening live. I'm going to be handling this account. You're going to watch all the moves being made 30 minutes before open, and then I need you to post your watch list below. Do not forget that. Please, please. It's very important. So now let's get into it. So I tried to take very concise notes on this, and we're going to go over it, and I'm also going to give you the summary, and we'll go through the transactions, but really quickly, it started with this bugger right here, the 215 calls in June. Now in February, I sold 4 of these contracts for like $600 a pop. I got like $2,400. You'll see that as we documented it, but they went against me and I was down $5,000 on these. As you see, I'm down $3,200 right now into close, down 77%. And this was sold premium. You see it's negative. So I sold the calls. These have unlimited risk theoretically, and we're going to talk about it. A lot of people, again, learn from this. Some of you who sell premium say, wait, you should have covered it, this and that. You'll see what I did here, but at the end of the day, too, it's all about defining the risk and where it's going to go. Realistically, out of the money premiums, that's something I figured here when I go to my max loss and is calculating everything. It's seeing, hey, if it did get intrinsic value, the out of the money contracts hold a $1,500 premium for 2 years out. And again, these have 2 years out, which is a very long time for them to expire. That's me taking advantage of the high premium, but the logic behind it is saying, hey, even if it goes, $10 in the money on 500 shares, that's what, $5,000 plus $1,500, or, that's another $7,000 for the contract. So, I added it up. It's going to be like $12,000. It's not unlimited, but it's not a small loss either. So that's the first part. But I got in that trade and it was down against me. So then what I did now yesterday, I sold another one. I averaged down on it. And then today I had an aha moment. I was like, I was kind of expecting too much. I was just going to go uncovered calls into earnings. So I got insurance. I grabbed some calls, and then I kind of went overboard, and then we added a bunch. But now what I mean by I went overboard with, I played this as insurance, and that's the biggest thing to note about this play. It all started with this. Everything stemmed from being on this play. This play, even right alone where it's at now, these 5 contracts, that has a carrying value of about $7,500 or some change. So it's not anything light. So that's where I started putting out bigger options and making bigger plays. So I made compromises. And that's where you're going to see the plays. I'm going to explain them. I made cheap insurance plays because it shows you how options work, where not every, you can't just buy calls and puts. So you have to go into a little bit strategically, but you guys are going to see what I did. So I sold those and I sold another one, but let's get into it. So you can see here, I told you guys the first trade, February 1st, I sold calls. So again, that's shorting the option. I agreed to sell someone the stock, but on the option part, I think the option is going to go down. So if I sell the calls, I'm shorting it. I'm saying, hey, I don't own the call. I'm selling it to some guy, and I'm agreeing to give him whatever the contract says. I want that contract to go to zero. That's how I make my money. So I shorted them. They're 2 years out, the 215 calls. They were at $6.20 a piece. I got $2,480 total. I collected the money up front, and that's the key here to notice. You'll even see with my risk of reward assessment with the premium side of this, when you sell premium, your max gain is whatever you collect. So the max I could make on this one trade is $2,400. So even when it was against me $5,000, the most I could have ever made was $2,400 net profit. I could have made my $5,000 back, which is a lot of what this play was trying to do. I'm trying to make my money back as well as hopefully give me some room for profit. But here's also how you guys should also communicate on stream anything with options. List the amount of contracts you get, the ticker, the expiration date, the strike price, call or put, the price you bought each contract at, and then how much you spent total for everything. That is how you communicate. You give me that information, I'm able to know and help you a lot better and understand what you guys are doing. So that was the first play, but notice what I said about being premium. The max I could get is $2,480. So then what I did, I waited 2 months, and you could see here on the play, here's the transaction history. Last, I set it to a custom date because I waited 2 months on this play. I think so. February 1st, you guys see there, sold Apple puts, the 619s for $620. But now look, here's every play. Next play after was Google, Amazon, Google, Tesla, Boeing, Levi IPO, Boeing, penny stock lesson, CMG, Tesla, Boeing, CMG, Google, boom, Apple. April 29th, yesterday. So that's when I'm deciding to average down. And I was down $5,000 on it because all those contracts. So think about it. It's the same exact contract now. And that was the second trade. I sold the same contract, but now it went up. I sold them at $6 and now they're at $16. So understand why I'm down. I said I sold these calls. I shorted them at $6. I borrowed it and sold it, but now they're worth $16.85. So if I had to buy them back, I'm losing $1,200 a contract. So I went and I shorted one more. And now this time I got $16.85. But now the difference is one contract is worth so much more. I got $16.85. That's more than 50% of what I got for 4 contracts. So now that one contract got me more premium. I have more money to be able to gain there. That's what made the position a little larger. However, that I took on more risk, but it's, that was my first average down. So that was yesterday. So now coming into today now, you'll see I was a little worried. I was thinking about it. I wanted some insurance. So then 7:20 in the morning, I bought the next trade, which was the 517 call. So then this is where I get into it now with buying further insurance. And now my whole intention with these next plays, and that's what I want you'll notice I have them in blocks. How I broke this play up was it started with protecting, and I focused it on protecting, trying to make my money back, make sure I'm not going to not only make my money back, that's not really the biggest concern, but it was to negate the loss or make sure I'm not exposed to a bigger risk than I needed to be and take advantage of what could happen with earnings in the premium. So I sold the premium. That's where I'm at now. So now the next play, I'm trying to get insurance, and I buy these in the morning to start scaling in. I get, see, that looks like it says negative. I'm dumb. Yeah, I had to take that out. I didn't want to confuse you guys. So next trade, I bought calls. So in the morning now, I bought 2 calls that expired May 17th. So these only have 2 weeks of time. So this is important to note with this play. And that's what I'm saying. Watch how these value tomorrow. But I got 210 calls. That's why I wanted to get them cheap so I could get in the money. But the whole idea, my strikes are at 215. So if there was a big pop and I was going to get killed on, the intrinsic value move with 500 shares, 5 contracts, plus that premium, this could help negate the damage by being in the money. So I only have 2 while I have 5 contracts, but that'll bring down it to 200 shares, but it's $5 ahead. So if it did go up 215 or to 210, that would have been, I would have had, if it went up to 215, I would have had $5 of wiggle room. But now, too, even coming back now, this is going to even come in. You guys, this is still the watch list coming into tomorrow. Watch Apple and how it moves. But what gave me my assessment today, I had that aha moment, the little epiphany, but it came down also down to pricing. When you looked at what Apple was pricing in, it closed around 200, I believe. Yeah, Apple closed at 267. Is pricing in about a $5 move around here. So 3%. And what I was pretty much saying was that it was going to come, and that's what it's moved after hours to 210. It did clip 212. But what I noticed, I was saying, well, if it's pricing in around a 3% move just under there, I thought it could move about 6 or 7%, double this move, and that's what gave me now the 215, the 220 range. So I thought it would be a bigger surprise. So I aimed 220, and I was going kind of for like a 9% move. I thought it was expecting 3%. I thought it could expect a surprise with anything from a 6, 10, 9, but I did factor some. I got more time. You'll tell on the other ones with a further strike. So I bought these 210s. That should give you guys some background in understanding these. So that is to protect it. Now I'm scaling in. I only bought 2 so far. Then the next trade throughout the day, and you'll see throughout the day today, I bought those 2, and then I did the Google play. We cashed out the 1600 on Google, and I made another one. But then come around power hour before market's closing, making sure it's Pacific time or not Eastern, I bought now June 212s at 246. So I spent another 700 to get 3 more contracts, but now 3 contracts plus 2, they're at 212. So now it's a little further. It only give me $2.50 cushion in between. But the idea is now, why did I get these? I got a little further out the money. I didn't want to spend too much to, again, if I put too much money on the table, the max I'm ever going to gain out of this whole play is whatever I sold the premium. And when I sell the premium, I'm only going for 50%. So if I'm putting too much money on the table, that money could get lost. So I wanted to make sure I had time. And 2, these are longer term contracts. So it could still go up, but these ones might not benefit. So I had to be very, very specific on the time. But my goal was try to get intrinsic value and at least make sure I have calls below the strike price so they're covered to some degree. So that's, you see now, the top 4 primary insurance, it's still cheap insurance because of the dates, though. These Mays are really risky because it might not go past $2.20 even if it does shoot up. This is all going to be an intrinsic value play. So these could go up a lot more because they have so much time, while these ones are going to be a lot risky. Same thing here with the 212s. So these are insurance. They're going to help negate the impact of a loss here. So now the next trades are secondary insurance, but they're more their own play based, again, now on those expectations. Like I said, I believe that it was, going to move beyond the priced in expectations of that 3% or the 2%. However, now I also had my own expectations. I saw what the market was. I made my own expectations. That's why I made the plays that I made. That's a big part of, that's how the market works. That's how every individual acts. So, nobody knows the key. So think about that when you make your plays. But another thing is it helped lower my purchasing power commitment. So my buying power, when you're selling premium and on margin, that gets affected when you're selling. And I was naked on these. So it had a bigger commitment the first time, but now by getting covered calls, or I did a ghetto spread, by getting strikes below it, I protected myself in the sense that it limits some of, I'm not having to put up cash secured because I have the right secured by other options, if that makes sense. So it helps free me up some room because I was worried. I was like, oh crap, I didn't want to sell this last one. Oh wait, I can't get there, but you'll see what happened. But I am going to sell another one tomorrow based on what happened. So be on the stream. So now these next trades, again, I wanted to act as insurance. I wanted to, get stuff where it still covered what I was doing. But again, if I was, what happened, I was expecting a no move. That's why I sold the calls. I was expecting a little, kind of what Netflix did initially before it ran up and just not really do anything. But I said, that could surprise. I think the market was kind of expecting something with Apple. It already moved up a lot. So I was like, it's not going to move much. But then when I had that realization, I was like, all right, let me get some plays a little out of here. But I wanted to go big. And why I went big with the puts, because, well, I had to go big with the calls to protect the position now. So I bought puts next, and you can see here on the timing, and I did these all within that last power hour. So again, be on the stream. We put it out on the stream. I set out for the stream alerts too. I said making big plays. I've been documenting it on the stream alerts. We've been letting people know if it is a put or a call and kind of giving people an idea. So I let people know. I said I'm making big plays on the stream alerts. I said we're establishing this position. So it started with all these plays in power hour, but now I bought these for $850. I bought 25 puts for June. So I wanted some time. And again, that would just make it too. And why did I want to buy puts? Because only downside I had now was selling the premium. So I was capped. So I said, hey, if there is a surpriser, I do kind of want my hand in the cookie jar, but I had to go big because then I was going to follow it up with calls, because then I wanted to make sure, because I didn't know it could surprise. I thought it could surprise up or down given everything that was coming into it, the expectations. So I also wanted now calls, but then I said if I'm going to get calls, I might as well get two birds in one stone and protect the 215. So I did kind of where I got June calls. They're a little outside, but instead now they're just outside the money at the 220. So if there was a major pop and I was going to get exposed to big risk, I wouldn't get hit too hard. These would make a lot, but the best part, I bought 10 of them, so it doubles my position size on the premium, so that could at least help me out and make some of it. So even if it didn't go, even if it went to 215 but not 220, the 10 contracts could still pull their weight with double the quantity. So as I said that there too. Accident insurance, if the stock blows past 215, double the contracts in case pop negates big loss from the first contract. There you go. Then next there was the 7th trade and the 8th trade, and then these were the YOLOs on it where I went out to next week, and I said again, same expectations. These ones were bigger quantities, kind of trying to protect the premium, because I was thinking about selling a put, but again, I'm going to use these trades to build off of more premium positions, so watch and see that. But now these were kind of the next week's, hey, big expectations in the price ranges. I think they can move just right outside that 9% range. I got a decent amount, $150 each, just around there, about $300 total, and boom. So now logic at this point, I'm down $3,000 on the first trade. It's worth $7,500 total. That's now the max I can make, and that is important because it's saying, hey, what am I going to be able to get out of this? And now the 2nd through 8th trade all the way up till here, I put $3,400, and now these are purchased options. So when I bought, these aren't selling. It's not sold calls. I bought them. I'm not shorting it. That's money where my max loss is whatever I put in. So I could lose up to $3,420, but I can make an unlimited amount. But again, this is protection. I'm only worried about what I could lose here, because that's a lot of money. And these ones, again, with earnings and IV, these are the most riskiest plays. So I'm like, all right, that's not good. So I'm saying I'm expecting a 50% premium crush. That's usually what I'm going to go for, because again, for it to go down 100%, the contract has to expire. So it's going to go down maybe max 70%, 80%. That's what we got on the Google, surprisingly. But assuming it goes down 50%, being conservative, we get, and then all the buys lose because you never know how it's going to work. But that'll be a $3,700 profit. That's assuming, you paid on this much, or no, it's $7,500 total is the carrying value. 50% of that is $3,750, but then we paid $3,400 for the options. Your net is $330 if you lose all the buys. So it wasn't really worth it, for holding that for 2 months. I shouldn't have bought as much insurance as I put there. So because the insurance is a risk, you guys have to understand that. And I have it in caps here. All bought options can add to the cost basis loss and make the trade even worse and underprotect me. And underprotect me, biggest problem of straddles, buying both ways, averaging down. Because you're buying more, the minute you buy more options, they're going to expire at 0. You're adding to the cost basis. So pay attention to how my logic is factoring all this in and assuming losses on everything I'm buying. You guys have heard this from me. It's on everything, and you're watching it now even with the big play. So I'm being conservative to kind of get it. And you'll see somebody like, you're selling calls. How are you being conservative? You'll see. But let's see. And again, so I went over that. Now, lastly, so that's my logic at this point, which led finally to the last trade. So here's all those trades you guys saw. We made those in pretty much like a 10-minute time span, maybe 20 minutes. And then lastly here, I sold it April 30th. So again, that was today. And again, I put the date I bought it so you guys could get contacts, but I took it April Apple, June 20, again, the same 2 years out, but a 230, further out of the money, not a 215, but I sold it for $1,000. So again, my max gain is going to be another $1,000, $975. So that at least added to some of the premium for me. But again, I bought more options. So if I'm assuming I'm going to lose on the bot options, and the bot options could protect me against a big run up or a big drop, I sold another one too now to make up for expending on expenses I'm assuming are going to go to zero. So by selling those same assets, selling that premium, I got another 1,000, which helped kind of balance it out a little bit, would at least let me walk away, worst case, with like 500. But again, everything with this whole scenario assumes that I'm right. That's assuming I hit 50% and it does exactly what I want. That's not always going to happen, so watch out for that. But essentially, wrapping it up, you guys could see, and even then, these 230s, they would give me premium. I would have to pay for the premium, and I'd collect more premium, but those 220s, remember I had 10 of them, those would protect me against that, and I would be up $1,000 on those. I'd be up actually, whoa, I think I'd be up 10 grand on those by the time those hit. But again, we'll see with everything else. But it's funny, I just said I'd be up 10 grand. I don't care. My max gain I'm shooting for here, $5,000, aiming for 50%. That's what we're going to see. I'm not here to speculate on the buys. The whole point of this was the protection. It could make a lot. If it does shoot up, I'm exposed, but if it does make a monster move and hit the second block, essentially, you guys see, this is the first trade trying to ensure this, cover myself, get calls below where I sold. This next one is going outside to, hey, market moves, big expectations, because if it moves 10, 15%, who knows? I could probably make 20 grand on these. And again, even worst case scenario, if it did shoot up and go crazy on the upside, and the most I'll lose is, I think I have it on here. I could lose, it could go up to 240 intrinsic and I'm down like 18 grand. So I could still walk away, but it's going to be a big play. It's going to be interesting. But again, I put my max loss as 15 to 25K. In the money, the pre-earnings premium is $14. So on all those big contracts I'm down on, even in the money on the apples, when you go to the contracts, if you go to the June 20th or the June 20s, you'll see that even at the money, or even like $5 in the money, if I'm assuming it's going to go to 220, these 205s, it holds about a $14 premium. So it says 19 there, subtract the $5 intrinsic value. So then that's what I'm calculating. It's $14. That's $7,000 right there in just premium. And then if it goes $5 in the money, 220, $5, $5 on 500 shares is another $2,500 of value. Add that to the $7 grand of premium, I'd be down $9,000 on the main trade. And then if all the buys and the insurance fail, I'll lose another $4 grand. And then I'll lose another probably $2 grand in premium from the 230 call if it shot up to 220. So right off the bat right there, that's like 9.5, 10, 11, 12, 13, 14, 15. So about 15.5 is the max loss. I put 25 because you don't know what premium could be or what could happen. So creating a buffer, trying to be conservative. But as you see there, that's in my mind, and that's if the market moves 9, 10%, but I do have insurance if it does go crazy beyond there. So even though there was uncovered calls in that, you can see how the risk is really controlled to a degree, or I at least know what instances would occur. Now, there is a possibility, and now it says if Apple does shoot up, it goes to 240, the intrinsic plus the premium would bring me down 18 grand on those contracts, plus another 5 grand and 4, that could get even worse if it does what Boeing did because of the quantity of contracts. So you never know, but that is a possibility. But even then, that would still bring the losses from like a low end of like 25, 30 grand up to maybe like 45, 50, but it's not unlimited. But again, that's still a pretty big amount of money to lose in one day. So you guys are going to see what happens tomorrow. Who knows? I have a pretty good idea. Well, we're going to see. I'm pretty confident. And then, yeah, I already explained the max game, but that's that. Let me know what you guys think. Do you guys think I'm going to win or lose? And again, who took the bet? Remember, any dollar I profit off of this, you have to do a push-up. Any dollar I lose, I'll do a push-up. So, muhahaha. But let's get into it. We cannot forget this is a watch list. So what do we got? Apple reports, again, look for the continuation, look for any big moves. But again, I can't believe I should have said this in the beginning of the video. Watch out for the Fed. That is going to affect the SPY tomorrow. I think we might get more moves early on, more rapid, either gap up or gap downs and quick moves, and then calm before the Fed and then a slight move after. Or it might be reverse. It might be very, very calm and then wait till the end of the day and big moves. So those are going to be the two options, I think. It could throw a curveball at us, but the Fed is going to release an interest rate decision as always, market's interesting now. We're at all-time highs. Data's been good. It's been a mixed bag, really, but mostly good. People are thinking they're going to now change their tone. Watch for any surprises, any quick U-turns, any quick tone changes, anything out of the normal or drastically different pretty much would panic the market, good or bad. Watch out for that. But other than that, just look for the volume afterwards. But that might suppress some of the moves. But we have the post earnings. So one of them is going to be Apple. But now a lot of your guys' favorites, AMD. So AMD killed it on the earning. I don't know if they ended up coming down. Yeah, that's a good one. We sold our calls before. I didn't want to hold those. But now let's see what it plays. But now that's going to have an effect, I think, on Microsoft. And so will Apple as well in one area. And again, that has the post earnings. So keep your eye out on that. But more importantly, NVIDIA. NVIDIA loved the AMD earnings. Also, so did Qualcomm, but Qualcomm also reacted negatively to some parts of Apple and vice versa. So keep your eyes out on for both of those. But AMD, the chip makers, it brought up Western Digital. So we saw it brought up XL&X, man. We saw what it already did this week with the chip makers, even the last few weeks. So it might be game on. Watch out for the cuck if it doesn't move. Be careful on the premiums. Be careful right off the morning too, because if it doesn't, and again with the Fed meeting, I think you're going to have opportunity for things to get cheaper. So we might be a little bit calmer in the morning. I think a lot more trades middle of the day, if anything, right leading up to that. But watch all those. So tech, but mainly the chip makers, Apple, again, Qualcomm, and Qualcomm is going to be reporting tomorrow. I totally forgot with all the earnings. We're going to have Qualcomm, but I'm not going to have a little fancy list. Here's earnings whisper. It could be missing some, but as far as earnings, you guys would be surprised. You guys were talking smack. Clorox, Bleach, man. Oh, they kill it for a stock. So honestly, watch them. Some of these value stocks have been surprising. I'm not even kidding. Watch them. CVS, I'm not as interested if it does surprise, which it could. We saw what happened with Walgreens, WBA. Yum, China killed it, so watch them. I think that could be another one. Even now, watch McDonald's for the continuation. They reported today, you guys. They had a nice move up. They came down. I think they're going to want it. You could watch Home Depot as well, but a lot of the value stocks have already reported. Even Starbucks made a move, but I like McDonald's a lot. But again, that's because Yum Brands is going to be in the morning. I think L3 Technologies is a good one in the morning. You see, there's a lot of companies. They're just the ones I like to highlight because not all of them are going to be move or be noteworthy. But again, Humana Insurance, that was up there. I forgot. But the whole idea here is that we're going to see. The best part is if it reports pre-market, we don't have to do any guessing. We're going to wake up tomorrow, so make sure you're on stream, and we're going to get and see what's moving and get an idea from there. Yeah, so nothing pre-market, but post-market, you're going to get Qualcomm, Zynga. I'm not a fan. I think some of you guys get that on your free stock. Watch Apache and CVX, even though that's the report, but there's Dexcom. What else was there? And Acadia. These are pharmaceuticals. I like them. Dexcom more so. ACAD used to be one of my favorite. Cruise, Sirius Logic, they could be a good one that's going to report. Caesars Entertainment, maybe. Qualys Systems, they're actually, those are one of the obscure names. I like them a lot. But again, we're going to have to see. We're going to go over these over the market. But realistically, I'm going to be looking a lot tomorrow to be playing Apple and the continuation, and if it's not going to be Apple, it's going to be AMD or the other plays. Now, that's what I'm saying, McDonald's, but then going back, don't forget about Microsoft. Now, even with the chip makers, XL&X, and I like Qualcomm too, especially after the Apple news. We're going to be focused there. Facebook and too Google. Google closed down 100, so I made a play. I even sold premium. I double dipped on it. I only walked away with an additional $70, but I'm going to be watching these. These are going to be the main plays, I think. Watch out for PayPal as well, too, and the financial stocks. And I'm singling out PayPal. I also like Bank of America, Wells Fargo, Goldman Sachs. You guys know with the 1DB thing and Goldman. But PayPal, they bounced a little bit. But Facebook announced stuff today, and you guys saw we were on stream. Facebook announced they had like a little security thing. Zuckerberg looked like a real human. He looked like he was in he's been coming to stream doing his push-ups. He looks swole. But they announced all this security, a redesign, honestly, a rebranding, and I guess it makes sense in trying to save face after paying a $3 billion fine. But they announced they're doing payment processing, kind of like a shopping cart, and PayPal dropped on that. But watch the banks now and some of these financials because of the rate hike coming up. And I believe Square is tomorrow after hours too. So watch out for that. But we will cover the pre-market or the post-market. And if you guys want, actually, how about this? You guys post below the top earnings that are going to happen post-market, and we'll cover those pre-market. But I'll have more of those. But again, I think really watching the continuations. Tomorrow's going to be an awkward day. Apple, you're going to have premium from Apple, premium hangover from Google, all this other stuff. It's the first day now, but there's still a lot of big companies. Then you're going to get the FOMC interest rate decision. The premium's going to be there, so watch out on Wednesday. Some things are going to we're either going to underprice things and think it's really expensive and it's going to surprise the move, or it's going to be really expensive because everything here, and then it's not really going to move much. And then we're going to see the continuation and the real moves start to happen as we enter in the new month. And, April's going to put, dressing on the windows here, call it a day, no down months, and boom, everybody walks away happy. So that's that, you guys. Let me know what you think. Drop a thumbs up. Subscribe if you're new. You better be there in the morning, and let's go.